March 24th, and I think we're getting near the end of leading off with rates. Rates will still be important, but I think the last Fed meeting in the press conference, Powell seemed to be comfortable with the plan to start tapering the balance sheet and cutting rates this year, irrespective of the reads on inflation that happened in January and February. He sort of just brushed them off, saying February wasn't that bad, he said, and the dot plot still showed 3 rate cuts this year. TLT got a nice support on that, but I think that the volatility in rates, I keep saying this, but I think it's pretty much over. I don't know that the Fed meeting being as boring as it was, I don't know that we'll continue to look at rates as leading the market. I think now it's time to turn to different measures of the economy in leading the market. And as I say that, the conference board leading indicators last week, I don't know if anybody saw this, were positive. They had been negative for the longest time. They're positive. They're now positive. Well, I mean, the index is not positive, but the last read was a positive read. Money market rates all well behaved out to the 1 year, and we now have gone from a bear steepener to a bull flattener on the long end, at least for the week. Curve inversion still remains 613 days on the 2-10 year. I think we're 2 weeks away or 3 weeks away from setting a record there. And the 3-month to the 10 year apparently is a record at this point. Canada also still inverted. Balance sheet runoff, another 27 billion, 12 billion coming out of the SOMA, down to 6.91 trillion. So with that, there was a net balance sheet reduction in assets, 15.382 billion. Money market funds, this is a big move, decreased 61.9 billion. Retail still climbing though, up 9.2 billion, both in government and in prime. Institutions down 71 billion, pretty much all coming out of government money market funds. Okay, next FOMC meeting, 38 days away. Odds 87.7, I shouldn't say odds, probability for 0, down from 93, 12.3 on the 25. This will be the last week that I put June in. I'll flip over to December because these are sequential meetings, May and June. I don't think there's incrementally more information here. At least one rate cut, at least one, coming into 75, 76%. So I think that's sort of what I agree with, that you probably have at least one rate cut by June. I think it's the June meeting. I think the May meeting will be some announcement on how they're going to deal with the balance sheet runoff. Because if they want to move the MBS down to 0, they need to recover the price on the MBS first. They sort of have to slow down the Treasury runoff because MBS isn't enough. They'd have to slow down the Treasury runoff so that they have more time to lower rates to recover the price on MBS so that they can then start selling the MBS and moving it into Treasuries. I'll lay out that argument right at the end here. Durable goods in 2 days. I think we start looking more at the economic data and the earnings data. I think rates have told the story they're going to tell. They're certainly not helping in understanding beta or understanding the macro. So I don't know that there's too much use in it. In fact, it hasn't really been that useful all along. Well, I shouldn't say it hasn't been that useful. It's been somewhat useful, but the indicators now just don't seem to be that useful. We have an inverted curve that are pretty much setting records in terms of duration, but it doesn't seem to matter. US GDP fourth quarter, we get our final look at that in 4 days, plus corporate profits. And last week, we got leading economic indicators, talk about indicators that are having little meaning, negative, 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 and it dropped to the point where it was below a certain number. That was not just a recession warning, but a recession signal. Never before has LEI dropped below that level, and there has not been a recession. Last week we got LEI positive. It's now turning up, which really wasn't talked about. So yield curve inversion signals, what happened with that? LEI signal, what happened with that? We seem to be in a different type of economy, and it could be because all of these things in the past were such clear signals that because these things happen, why not try to develop securities that hedge against these things? That if these are a risk to you, let's hedge against certain things. So I think the financial sophistication of the market has gotten to the point that companies can basically immunize themselves from a lot of things, so that the signals, while they are there, don't mean much to the companies because they have used derivatives in a way that offsets what they would have naturally experienced. If you're into the grains, corn, soy, and wheat, in 4 days, prospective planting is out, and in 5 days, US PCE market is closed. Good Friday. Monday, Bostic and Cook. Tuesday, Waller. Friday, Powell at 10:30. Not much in auctions this week. Tuesday, the 5-year note. Wednesday, the 7-year note. Not really risky tenors. It's the 10-year and the 30-year. If they have auctions and they come out at a yield different than where the market is, that's always something for volatility. Effective federal funds rate 5.33, 12-month lag 4.83, so you got 50 basis points. Still, I look at this and I think I'm not on board with the lag as much as history would say that it operates with a lag. It just doesn't seem to be affecting very much. And if we go on the basis of each recession, more and more, a greater and greater proportion of assets and liabilities become immunized from changes in rates, and what lag, right? Reverse repo up 64 billion, which extends out the date at which it hits zero, but week to week there's always volatility. I don't know that we can read much into this one. TGA up to 812.6, and offsetting the increase here is you have a decrease of 83 billion on reserves, 3.489. It's the combination of the two that are going to matter for what is an ample reserves regime. If you think I do, 2.5 trillion, add the two, subtract 2.5, this number is lower. Week on week, 1.468 trillion. At current runoff is 15 and a half months. Now, how much rate cutting can you get done in 15 and a half months? If you think, well, we have 9 months left this year, and we think there's 3 cuts, so that leaves 6 more months. Let's say in those 6 months you get 3 more rate cuts. There is 6 altogether. You get down to 4%. The vast majority of that MBS was added when the policy rate was 0%. So if you're going to, as Waller says, move MBS to 0, and Powell seems to agree to move MBS to 0, you're going to have to sell MBS because the runoff isn't going to get it done. You'll be 30 years getting it all off your books if you wait. Well, I wouldn't say 30. I think prepayments would take out a lot, but you call it 15 years getting off your books. I think they want to do it in 2 or 3 years. You're going to have to sell at a loss. They're not going to want to sell at a loss, which means they have to have room to cut rates. 15 months is not enough time. You need more time to get rates down far enough such that you can start liquidating the MBS without dislocating the market. There's like 2.3 trillion of that stuff, right? So you got to get rates down so that they don't take a loss, So you got to extend that 15 months. There's not enough runoff in MBS. There's only 15 billion. The rest of it happens in Treasury. So you're going to have to extend this 15 and a half months. Hopefully, it may be out to 30 months so that you can get your policy rate closer to 2% and then maybe even 1%. I think the end game for central banks is 0%. And I'll explain that in a second, but I think there's the problem, is your Treasury runoff is going to leave you no time to get rates down far enough such that you don't take a loss on the MBS when you do liquidate them. You want to get them to zero. That's a big hit to take in liquidating those, because you're going to have to sell them. Now you got price risk. So they're going to have to get this 15 months out longer to 30 months. I'd say when you get to May, look for treasuries to be cut in half. I think that would be a safe bet. Leave the MBS runoff at 15 billion or whatever you're getting per month, because it's really slow at 15 billion. And take the treasury and cut it in half. This would extend this out to maybe 25 to 30 months, which would give enough more time for interest rate cuts to push the price of MBS back up so you can then start selling it. The other thing they want to do on the balance sheet, you have assets and you have your liabilities. Your liabilities, your reserves, the interest is being paid on reserves. That's how you keep an ample reserves regime, is by paying interest on it. That is going out at pretty close to the policy rate. But your assets have a duration and you have different points on the yield curve, and right now you have an inverted yield curve. So your cash flow in is not matching your cash flow out because of the inversion. That if you move your assets closer to a duration that is not interest rate sensitive, T-bills, anything 1 year or under, then the cash flow coming in on your assets pays for the cash flow going out on your liabilities, and you don't end up in a situation where you're paying this much on reserves but you're only getting this much in on your assets. So they'll roll whatever they do, start buying. May not be to support the long end of the curve. It would be in the money market rate, which means that there is no form, by the taper, there would be no quasi form of quantitative easing on that part, because they're not affecting longer term yields if they stick with money market rates, and we know money market rates stick very closely to the policy rate. Why do I think the end game is 0% for central banks like the US, Canada, UK? We've already seen the Swiss National Bank do the first cut, is because of two things. Number one, technology. Technology is deflationary, and it's not slowing down at all. So if you're a central bank and you have a mandate of price stability, you have the short term and you have the long term. In the short term, you think, well, inflation is above the 2%. But I really should be careful how much I try to crush it now, because it is, at these price levels, it is going to accelerate technology in some areas. And we know that technology is deflationary. If I look out 10 years, technology will solve a lot of the problems. And technology is finding its way into more and more and more aspects of your life, more so than 10 years ago, even more so than 20 years ago. That won't stop. There is monetary policy right there, is stay out of the way of technology, and it'll take care of inflation. The other thing is debt. The sheer amount of debt in advanced economies, that has to be paid for, and it has to be paid for out of tax revenue. So what happens to an economy when you go from 10 cents of every dollar to 15 to 20 to 25 to 30 cents of every dollar going just to service debt? And in the US, when you have money going to service debt, some of it goes to Japan, some of it goes to China, some of it goes to other foreign banks that are holding on to treasuries. So it is a leak in the ship. You have a couple of leaks in the ship, because if that money were all going to its own citizens, well, then that interest income is then retaxed again. But when it's leaking, when it's leaving the country and going to other central banks because of their holdings, that's just a leak. Think about fiscal policy. If suddenly you go from 10% to 25% of your tax revenue just to support debt, and what social spending you can get done, what social policies you can get done. C plus I plus G plus X minus M, there's G. And if you have a lot of the tax revenue going to support debt servicing costs, you can't lower taxes. So usually if you have G lowering, because let's say taxes are lowered, in a Keynesian world, consumers would have lower tax rates, then end up with higher spending, it would offset. But here you have lower government spending without any offset to C or I, just by servicing the debt. So if you think about higher for longer and go out 15 years, the decisions today will cripple that government and will cripple the amount of growth you're going to get out of an economy, because the government simply can't afford to invest more, or more likely debt will just keep growing and growing and growing, because the government will say, yeah, we got to spend that much on tax revenue. We're just going to have to live with bigger deficits because we want to spend more on social stuff. We want to spend more on this, more on that. Everybody gets a free car, right? So you have a situation where you're either going to have just growing debt to a point where it is unsustainable, or what you can do is bring your interest cost all the way down to zero to eliminate the need for bigger and bigger deficits and hope that the fiscal will balance a budget. But you got to give them breathing room. So I think the combination of technology and debt leads to, in the long run, a 0%, I say long run, pretty much from here going forward, a move towards 0% interest. Real rates all giving way, moving back down. The 20-year probably next week, I think we'll see it under 2%. I don't see anything at this point that would really drive rates on a step higher. TLT up 1.12%, SPY up 2.29, implied volatility on on TLT, nothing. If we look at the 93 put, it's got a delta of 0.353. We're sitting at 94.03. This is April. The April put 85 cents. I mean, it's something, but it's not that profitable. Having a look at Fed funds futures, week over week, Q2 is pricing in 15 basis points, at least by the end of June. We got 15 basis points lower on the implied effective federal funds rate. Q3 another 26.5, Q4 32 for 73.5. Fed sitting at 75. It seemed rather balanced. I still think a long December Fed fund futures makes sense. Worst case scenario, you get 3 rate cuts and the December Fed fund futures really doesn't move that much. You don't get anything on the downside. Best case scenario, you got to go more than 3 because inflation falls faster than you think, only primarily because of more and more increases in supply. Yeah, I still think that selling the 93 TLT does make sense, but you're not getting paid a lot. You're getting $850, 85 cents. You're getting $85 on, it's 93. You got to figure out, well, how much margin do you need to use, and your 85 divided by the margin, I don't know is got a really great percentage on it. That if you were thinking about a trajectory that TLT may move up, you might want to go out maybe 3 months or so and say, well, okay, I think in 3 months we can see maybe 97 on TLT. At that point, I think maybe it might be worth selling the 96 puts. You'll get at least the intrinsic value in it of $2, probably another $1 in just time value. The 97s probably going out 2 months, 3 months, might have $3 in there. That might be a better use of capital, so that as TLT, as time goes by, the time value will approach 0. And if TLT does go up, the delta increasing will decrease the premium as well. So you could just say, well, let me play the forecast on this, and I'll sell a 97 put out 3 months from now, and I'll get theta decay and delta at the same time. If you think there's good support to move up from 94, where we are now, to 97. I think there's firm support at 93. I think 93 makes sense to sell puts, but with such low premium, I don't know if it makes sense from a capital, from tying up capital, unless you have money in T-bills. Unless you say, well, I've got a whole bunch of 90-day treasuries anyways. The treasuries do act as collateral. At that point, you're getting double use out of the collateral. You're getting a 5.5% yield on the collateral, and it serves as collateral. Your collateral is earning at the same time. Then okay, if you have that set up. But just on its own, I don't know. I think there's probably better underlyings if we're looking to generate income from theta. The 30-year fixed rate mortgage, 6.87%. Spread, based on how the 10-year treasury moves, spread increased 15 to 260. Had some good data for the housing market last week. The housing market index, which is a diffusion index, up at 51. The expectation was for 48. Last week you had some of the big housing stocks hitting 52-week highs. DHI, 52-week high. This was for March. Building permits up 1.9. Housing starts, big number, up 10.7%. Existing home sales for February up 9.5%. Those are big numbers. Mortgage apps for March 15th down 1.6. Monday, we will get new home sales for February. Tuesday, we get the housing price index for January and Case-Shiller as well. And Thursday, pending home sales for February. The chart I have up here is XHB, the home builders. It's a 3-month chart. Kind of had a little trouble at 100 for a while. February 22nd broke out of 100 and straight up to 110 since February 22nd. An ETF. I want you to keep this in mind now. This isn't a stock, it's an ETF. Within a 1-month period, where are we? March 24th, it broke out February 22nd. In 1 month, you're up a little over 10% from that breakout on an ETF. So the housing stocks still continue to perform, and you do have a shortage of housing in the U.S. Although inventory levels are starting to increase, it's still quite low. What is increasing in the U.S. is the amount of immigrants coming into the country. That is going to put pressure on housing. So there was some thinking that multifamily residential had some overbuilding and might be in trouble. But when you have 3 million people coming in over the last year, that's just in the last year, well, those 3 million people got to live somewhere. I mean, they got to go somewhere, right? So housing just continues to perform. I think that once you start to get rate cuts, I'm sort of torn on what will happen. On the one hand, housing becomes more affordable, but you'd still have to have the 30-year rate drop considerably, because a whole bunch of mortgages were taken out when rates were significantly lower, where mortgage rates were, I don't think 100 basis point lower. 5.87 is going to bring a lot of inventory back on the existing home side. But as rates go lower, it will increase demand, but it will also increase supply because it becomes more affordable to build spec homes at lower interest rates. So you might have supply growing to meet demand. The outcome on price is uncertain. So I don't know how much room the home builders have to go, but I think that they will have robust profits for years to come. I just don't know how much more upside there is. A lot of upside is already in there, but I think they have more to go once rates start dropping. And then it's just a matter of keeping an eye on supply. How is supply increasing relative to demand for every 25 basis points? Corporate, the OAS corporate spreads still contracting even more. Your investment grade at 91, your high yield at 305, AA 48, triple C 846 basis points, down from 849, still moving a bit, but the corporate world is seeing nothing to pay attention to here. Okay, let's have a look at OXY, and then we'll have a look at copper. Last year, OXY bought Crown Rock, which was a private company in the Permian Basin, added 170,000 barrels of oil equivalent per day to their productive capacity, paid $12 billion, a combination of debt and asset sales. For 2023, they paid $600 million in common dividends, $1.8 billion in share buybacks, and $1.5 billion in preferred share redemption, returning $3.9 billion to equity holders. They had announced last week they're going to focus on paying down debt over share buybacks. They want to get their debt level down to $15 billion over the next 2 years. So how much work do they have to do there? Used Edgar, found the December 31st, 2023 year-end statements. Current portion of long-term debt was 1.2, long-term debt 18.5, a total of 19.738 billion in debt. Want to get it down to 15 over 2 years. That is a $4.7 billion reduction. So we can expect share buybacks to head to the zero mark on this. Preferred share redemption, unless it's contractual, probably head to zero. The dividend, I don't see that being being cut. They're paying down debt over share buybacks. If you got 1.8 billion that happened over 2 years, it's 3.6 billion, and they want to get this down by 4.7. After they get that down to 15 billion, they'll go back to buying back shares. Implied volatility here, zero. It's hard to find, I shouldn't say zero, implied volatility percentile is at zero, meaning that 100% of all the observations in the last year were higher. 26 day to expiration, 61 puts, 34 cents, hardly even worth it. We're sitting at 63.81 on OXY right now. And 26 days to expiration, a 61 puts only offering 34 cents. 52-week high, 67.66, happened back here. If we look at their chart on a more technical basis, you had some resistance here. It sort of had trouble at 61.50, and then it broke out over 61.50, and it just ran. Way back here, you can see that you had sort of a head and shoulders going on. And if we take this from the peak of the head to the neckline and extend it down, that looks like what we've had here to some degree. And now we have a breakout over here with not a lot of value in selling puts. Berkshire keeps increasing their ownership up to 28% ownership, but has said that they're not interested in taking this company out. But 28% ownership. If we go out to January 2025, I'm trying to find some interesting plays on OXY. Looking at a risk reversal, the 57.50 put, sell the 57.50, buy the 72.50 call. It will cost 70 cents. Figuring that you have a 52-week high of 67.66, you have a lot of consolidation going on in the energy sector, and I think you're going to see more wells being, I wouldn't say, discontinued, but at least shut off as the larger companies are buying up the private companies. Private companies are more than willing to, extract what they can out of wells. Public companies will look at the extra supply that well is giving versus the cost of getting it, and will shut down the less productive wells. So I think the supply, U.S. oil supply, is probably peaked and probably going to head down with more consolidation. That could support price. And if Berkshire does do something on a takeout, at least you have the call on this side. I don't even know that this is very interesting, to be honest with you, doing a risk reversal. OXY has had trouble once you get up to about the high 60s. OXY seems to have trouble getting much above that. I don't know that they can do it organically without a takeover. and Berkshire at 28% has said they're not interested in a takeover of it. So even that, I'm trying to find something interesting in that. I look at that, I think, well, for 70 cents, cost me $70 to get done, plus whatever capital I'd have to put aside to support the put, on the off chance that there is a takeout at, what could it be, 10%, 20% premium. We're at 64. That might bring it to 75. Not that excited about it. I would seem to think that the 61.50 represents a good line instead of the 57.50, which was down here, and the 55s. These 2 points were great for selling puts for quite some time. I think the 61.50, if we see the price retrace back down to 61.50, the 61 puts might be the first stop. I just don't see the value of selling it now to get $34. The amount of capital required for the 61 put, the $34 as a percentage of that, I think is like 0.5%. That if you were able to do that for 12 months, if you did it every day for 12 months, you would have earned more putting the capital you would have required into a T-bill. So it has a lower return than the T-bill. Let's move on to copper. Yeah, to finish up here, I don't know what the play is on this one. You can't, on every target you have, you really can't sell puts every single month. That's why it's important to have a whole bunch of targets that you're interested in. And at some point, Oxy is going to have a bad period of time. There'll be inventory bills for oil and for gasoline. And for a couple of weeks in a row, that'll put downward pressure on oil, and Oxy will probably move down with it. Any significant move down to 61 or below 61, I think there is the opportunity. Get some more implied volatility in here first. Let's move over to copper. Copper had a nice run up because of the China smelter cuts, but it just didn't seem to me to be something to build a continued price appreciation thesis off of. And we've seen copper pull back, and it finished under $4. Goldman Sachs last week in their report, global visible copper stocks as a percentage of demand have decreased to levels not seen in recent history. That's a bold statement. Copper coverage ratio is in the 10th percentile, which means that 90% of the observations in the past for the coverage ratio have been above that. Record low copper stocks. Anticipated mine supply limit by 2025 and robust demand growth for green technologies is the thesis behind Goldman Sachs report. And I sort of agree with that. If we look at copper just recently, it had some resistance sitting around 395. It firmly broke out over 395 on an inverse head and shoulders pattern. So if we take this distance and move it up, it has already done that. But the smelter shutdowns in China were you had capacity that was being shut down, capacity that wasn't even being used being shut down. It wasn't as if it was capacity being used and now it's offline and oh my God, where are we going to get refined copper from? It wasn't even being used. So that's why I thought, well, that's a little much. Last week I said I think it might be worth looking at selling either the $47 or the $50 calls on FCX, because I just don't see this as the basis for a sustained rally in copper prices. But I do agree with the longer term thesis that by 2025 you're going to be in trouble, and that copper stocks, FCX has been warning about this for some time, that copper stocks are extremely low. I think the story is still in there for a long-term run in copper, not holding above 4, but above 5 and maybe even above 6 by the time you get into 2026. So I still think FCX and COPX represent good opportunities longer term. But for now, I would be selling the calls on FCX, because I think this breakout, I think on the news, okay, a bit of a relief breakout, but I think it was premature. You get much downside on this. I think I'd probably be looking somewhere around here, 375 to, where are we here, the shoulder on this side, 385 to 375 puts on HG. You know, if I'm doing 385 to 375 puts on HG, wherever FCX is at that time, I think 30 delta calls on that. So if you see copper pushing much below 390, 395, reaching this breakout much below 395 down to 390, I think I'd be looking at the 385 puts or 375 puts, depending on your level of comfort. Okay, gold and Bitcoin both failing. Gold tried again. We can see over here it opened up well above 2200. It was the story of the day for a while, and then just sold off, and then of course sold off again the next day. 2200, it couldn't hold here, retreated a bit, tried again, failed over here. You now have a double top, and which is, every time you have a failed top, it makes the resistance even harder. But there is a saying, there are no triple tops, which means if it makes another run again, if you believe that technical wives' tale, then maybe that'll be the one that breaks it. But it doesn't seem to have a lot of support much above 22. Bitcoin 74 is the top. You have just one single line of resistance, but you have trouble over here. The green bar over here, that was the Fed day, and then Thursday and Friday failed. It failed to claim above the Wednesday close. Thursday closed below the Wednesday, and Friday closed below the Thursday. So the Fed had brought the price up, but then the next day, nope, and the day after, nope. MicroStrategy bought 12,000 Bitcoin at 822 billion, bought another 9,245 at 593 billion. And this was financed by senior unsecured convertible debt. Talked about that last week. They had raised convertible debt at a very low coupon, which convertible debt usually does, and used that to buy this. That wasn't from cash flows, that was from a debt raise. So how long can that continue? How many more debt raises is it going to do? So that was probably a one-time demand. You also had a whole bunch of ETFs that launched, 11 ETFs. But if we look at the Bitcoin ETFs, the initial euphoria appears to be waning, that the early adopters who wanted it are in, but where's the follow-through? We'll go to this website shortly. This is the funds flow for the different ETFs. They're all at the bottom. It's hard to see, but you can see over this period of time downward. Let's have a look at this website. Okay, so this is net flows, and the orange line here is the price of Bitcoin, which is on the right axis. And net fund flows are on the left axis, and here is the zero line. And you could see for quite some time the net flows were positive, and then they've turned negative here from early March. March the 5th, they just started, let's see, they turned negative right around here, but they peaked and then have been going down since. I've just got the grayscale ETF up here, but we can click on the BlackRock one to see it is sort of showing the same thing as well. I'd like to be able to point out with the mouse, but when I do, when I move the mouse, you get this little box that covers everything, so it's kind of hard to show what's going on. And I just put my finger on the screen to say, look, it's going down, but you can't see what I'm doing there. But the link for this is in the description box. The link for everything is in the description box. You can see it in terms of assets under management, 52 billion, the total up here. You can see 60 billion, down to 52 billion, and this was March 12th, the first number, the dark blue dot, 60.3 billion. We're now down to 52.6 billion, so you can look at it as assets under management or net flows. Same with down here. You can look at, they have more charts down here. So I'll leave this link in the description box and you can play around with this site. Okay, let's look at GM. Hit a 52-week high on Thursday, 43.66. Broke out after their last high period. Sold all the way into the 28s. Did announced a really big stock buyback, and that just set things in motion. Well, what was the cause of this latest run-up? Breaking out over 41, 42 to hit new highs. More mileage credits. This was from the U.S. government. More mileage credits for building EVs to meet U.S. fuel economy requirements. So for every EV that you build, you get even more mileage credits now. That allows GM, Ford, Stellantis to build more gas-powered vehicles through to 2030 and still meet the CAFE standards, the fuel efficiency standards. Previous to this, at the old level of credits, by 2027, based on how many EVs they were building and ICE vehicles, they would have faced fines. The estimate was between 2027 and 2032, GM would have faced 6.5 billion in fines for not meeting the standards. This now pushes it out from 2027 to 2030. Ford would have been $1 billion, Stellantis would have been $3 billion, so GM is doing really well, or will do really well on not having that cash outflow. So 52-week high, 43.66. I think if the market doesn't start giving them respect, looking at the internal combustion, saying, you know what, this is going to be with us for a very long time, let's start pricing this out in terms, and I've said this before, these car companies are cigarette companies because they don't have to put a lot of CapEx into the ICE side, lower CapEx, so this is a harvest situation for years to come. Very solid cash flow. So unless the market starts showing them respect, I think they will fall back at the end of the year to more buybacks, to more share buybacks. We'll see how the market treats them. But so far it's treating them well. 52-week high of 43.66. You know, when you think about in November, they were sitting down around $27, $28, being at $44. That's quite a return. The yen, dear God, the yen, were right at the same level we were at when you had BOJ intervention. Not once, but twice the Bank of Japan intervened. They stepped in at the 150 plus level twice before. We're sitting at 151.41, pretty much near a 52-week high on this one. All on the Bank of Japan ending negative interest rates and scrapping yield curve control. That is what they have done, but no follow through. It does not look like they're going to move very much from there. They will continue to buy bonds, but not targeting any specific yield, but continue to buy bonds. They have no choice. They have no choice. Debt, government debt is 263.9% of GDP, and you have a shrinking population. So it's hard to get GDP growth with a shrinking population and an aging population, which means more social spending. So you have a debt level that's going to continue to increase. But keep in mind, you have, you know, if you talk about debt to GDP, you have debt that's going to increase in GDP that's going flat, or even at some point going to start to decrease, because you can't keep getting higher and higher growth out of a smaller and smaller population. This percentage is going to get even worse. And with a shrinking population, your tax base is going to shrink. Just servicing that debt is going to be impossible. You have to keep the cost of that debt as low as possible, and the central bank has to monetize as much of it as possible. So they'll continue to buy bonds. They're not moving from the zero. They're not moving from the zero. Is the central bank going to intervene? A lower and lower yen is better and better for exports. If you can't get GDP up with C, with I, or with G, you got to get it up with X minus M, right? And a lower and lower and lower yen just makes everything cheaper coming out of Japan. You can't raise interest costs for the government that would destroy the economy with that level of debt. I think this is as far as the Bank of Japan goes. I think this is as far as they go. Would they step in at 155? I got a hard time. If I were in charge of the BOJ, I would say, but why would I do that? Why would I do that at this point? I'm holding on to U.S. Treasuries, so I've got what, $1 trillion in that, or somewhere around 850 billion to $1 trillion. So that's just going to buy me more yen. That's just kind of helping out. Is it so bad to go to 160, 170 if it's going to get our GDP up by selling to the rest of the world? Although I'd be hesitant to put a carry trade on at 151.41. I'd like to see what the rhetoric out of the Bank of Japan is when it does 152, 153, 154. And if you start hearing conversations that, well, they would be comfortable to 160 or 170, then I think you have permission for the carry trade. But here, BOJ has been known to step in. However, you have this going for you. If you can live through the currency squeeze, you have this going for you. It doesn't work. It hasn't worked in the times that they have intervened on the weak side. It hasn't worked. So I don't think they're willing to do what it takes to strengthen the currency with monetary policy. They'll do what they can by stepping in and defending the currency with open market purchases of the yen, selling some treasuries and buying the yen. They'll do what they can, but I don't think they're going to use monetary policy to get it done, anything more than just buying currency. I don't think they're going to use the monetary policy tools such as not buying bonds and allowing yields to begin to increase, which would then strengthen the yen because that would weaken the economy. They are stuck in this trap, and there's no way out of this trap. So they may as well make the most of this trap and say, well, instead of trying to run out of the forest that's on fire, let's run through the fire because the other side is burnt. That's probably our safest way. Let's run to 170 or 175 on the yen and boost our exports. And let's make sure that our corporations can borrow at very low rates so that they can invest in productive capacity to meet the demand for exports that happens when the yen is 170 or 180. That's a way out, right? But still, I'd be nervous because I haven't heard enough conversation out of the Bank of Japan about how they feel about the level of the yen. But if they're comfortable here, I don't see why 170 can't be a destination for the yen. It would only help Japan. Okay, Russell 2000. Found some information, but I don't know how to read it. It's not that I don't know how to read it. I know what each of the exhibits say, but I'm getting, if I look at the forward 4-quarter earnings, I'm getting 3 different numbers all in 2 exhibits, all on the same page. I'll show you that in a minute, and then maybe you can figure out what's going on there. This is the Russell 2000 closing at 205, the closing on the index 2072. This is the IWM here. 2024 forward earnings of 80.04. I get this from page 8, exhibit 24. I'll show you in a minute what I'm looking at. The link is in the description box. 52-week high of 21.15, sitting at 20.72. Coming up on a 52-week high over here. Well, I think they printed their 52-week high over here just this last week and pulled back to 20.72. 25.88 times forward earnings. Seems like a lot. We look at 2024. Look at the chart at the bottom here. This is Exhibit 4, 2023. The actual earnings growth was negative 19.2 on the Russell 2000, and this is year-over-year growth rates. 2022 Q2, there's 2023 Q4. Here's the forecast, 2024 Q1. You can see the E on here, estimate 2024. 2023 Q4 still has an E on it because not all the companies have finished reporting, so it's a combination of reported and expected. But we can see the growth rate 2024 Q1 -9.7, but look at these growth rates year over year, 21%. This is the blue dot for earnings, 21%, 39%, 56.5%, 42, 29, 23. Those are big growth numbers. Even looking at net income, they're fairly large growth numbers in the growth rates that are coming up. Let's have a look at where I got this from, and maybe you have some ideas on why there are three different numbers for forward earnings, all within 2 or 3 inches of each other. Okay, let's start at the top of page 8 here. You can see the date, March 20th, 2024. We're March 24th. The close was the 22nd, so this is as of Wednesday. I don't think earnings have changed much from Wednesday to Friday, so we'll go with what they have here. This is the 3-month close and forward 4-quarter and trailing 4-quarter PE history. So we can see on a forward basis 25.5, on a trailing basis 29.8, which is exactly what we get in Exhibit 23 down here for valuation metrics. Based on the close as of the 20th, the trailing earnings 68.30, forward 79.85, so there's where you get your multiples. 79.85. Let's go down to Exhibit 24. This is industry analyst estimates, Russell 2000 bottom up, dollars per share, quarterly reported results and future expectations. So obviously 2009, 10, 11, 12, those are results. Once we get to 2024, that's all going to be expectations. CY calendar year 80.48 for 2024. Forward 4 quarters 79.85. But if you add up the 4 quarters over here, they do not add up to 80.48, nor do they add up to 79.85. They add up to 80.04. So you have one number for the forward 4 quarters is 79.85. You have another number that's 80.48, and if you add up the 4 quarters, you get 80.04. I cannot believe that this document is that sloppy, that there are that many blatant mistakes. I can't believe it. So there must be a methodology I'm missing. In fact, if you go, let's take 2021, 67.71. Now 2021 has happened. It has happened. So we know 67.71, but go ahead and add up the 4 quarters. You're over $70, but this is 67.71. You do the same thing with every line. Add up the 4 quarters, doesn't equal the line. So is it just that it's that sloppy? They have an intern doing it, an unpaid intern doing it, and it's that sloppy? Or am I missing a methodology? How can you have 3 different forward numbers, 79.85, 80.48, 80.04? How can you have 3? Unless they're measuring 3 different things, and I'm just not picking up on it. So if anybody has any idea how I can make sense of those 3 numbers and which of those 3 numbers are relevant for me, which one should I be using? It can't be all 3, and it can't be flip a coin. It must be one of them. I'm missing something somewhere. I don't know what it is, but there we are. The link is in the description box. Okay, SPY, forward 4-quarter operating earnings, IBES. Non-existent, nothing this week. Must be busy with March Madness. We're just going to use last week's 243.31. SPGlobal 240.23, down from 240.77. Not much move, so I think we're fairly safe in just saying, well, let's just use the same one. We get to 21.65 times forward earnings, up from 21.14. Adjusted for 6.3% earnings surprise, because that was Q4 earnings surprise, 20.37, up from 19.89. There is some implied volatility in here in terms of the percentile. 13-week 16th percentile, 84% of the observations were higher. And on Thursday, March the 20th, Wednesday, March the 20th, hit an all-time high. On a closing basis, 521.88, sitting at 520.75, just slightly below that number. Actually, I think this was in extended hours. The closing was actually higher than that. We are 0.128% below the all-time high on a Friday closing basis, 521. You don't have the central bank standing in the way anymore. The central bank is not a headwind. It is firmly behind the market now. Rates are dropping, inflation is dropping, but inflation dropping is a headwind to revenue growth. That if you think, well, inflation will continue to come down, well, inflation are prices. That means the rate of growth in prices, instead of growing like this, is going to start to grow like this. So, you know, when you're looking at growth period over period, it's not going to look that good. How's that going to translate down into earnings growth period over period without some cost reduction? But if you have cost reduction, that means that is somebody else's revenue reduction or income reduction. Interesting to see how that plays out over the quarter for earnings, and how many more you know, staff rationalizations will there be, what they call productivity increases. When a company says we will be looking to increase the productivity of labor, that means layoffs. If you hear that terminology, that just means layoffs. There is really nothing standing in the way of the market right now. The big one, the Fed, is now done. Nothing standing in the way except its own fundamentals, earnings and earnings growth. You also have AI, and AI is hard because AI is a promise. It's something that's going to happen in the future, and it's going to be fantastic, and it's going to be unbelievable. So AI is a promise. That is hard to argue against. So, you know, I keep feeling like it's 1999 all over again with, you know, .com. Now it's AI. NVIDIA got another price target upgrade. KeyBank, $1,100 price target on NVIDIA. Closing price, weekly closing price, $942.89. That is up $64.52 week over week. I think $974 is its all-time high. I think our market cap on this one, let me see if I can find that very quickly. Market cap 2.36 trillion. 2.36 trillion, and the thinking is, well, this is that it could hit $3 trillion. That sounds like a big number, 3 trillion, but we're at 2.36 trillion right now. So if you think about it, if this is a 1 year target on NVIDIA, let's say, you know, round that up to 2.4, you're going to 3. You're 80% of the way there, right? So what have you got to get from 80 to 100 is a 25% increase. So you have perhaps another 25%. 25%. Are there other stocks that can provide, you know, 40, 50, 60%, 70%, 80% growth for the year? I don't know. Unless you think, no, it's not 3 trillion. We'll go to 4 trillion. Keep in mind, it's got a market cap right now of 2.36 trillion. I want you to start putting that into perspective of, well, where do you think it can go? 4 trillion? You think, if you think, oh, there's another double in there, then what you're saying is it can get to 4.72 trillion. Never, ever has a company ever done that ever in the history of markets anywhere on the planet, ever. That's what you have ahead of you if you think, oh no, it can double again from here. How much more gains can there possibly be at this size? How much growth can you possibly get to justify this size? Unless you think, well, you know, this is primarily all priced in. The hype can go on a lot longer though. AI, and this is AI central. This is ground zero for AI. So as long as they keep the dream alive, yeah, they could probably 3 trillion, probably 1,100 doesn't seem so far away when 974. They're at 942. I mean, if you want to think about it a little bit more clearly, it sounds like a lot, 1,100, but let's just assume this was a stock that was $9 and what is it, 43 cents? It's $9.43. And somebody said, oh, I think this gets to $11. You think, well, it's $9.50. You think 11? Well, that's was that $1.50? You know, well, that's sort of a way to put it into perspective. And there we are. I see no reason to short this market. Nothing is really standing out as being in the way. The central bank is out of the way. They're not a threat. They're a tailwind now, and you have something that is very difficult to argue against, which is an idea, AI. And that's it.